If you've been holding highly appreciated tech stocks recently, you are going to want to pull up a chair. Welcome to today's Explainer, where we're tackling a really fascinating psychological dilemma. We're going to walk through some absolute gold from the Fat Investor blog about handling the massive run-up in local Singaporean semiconductor stocks. You know, as investors, we spend so much time sweating over our losses, but dealing with life-changing gains, that takes a completely different mindset. Let's look at how to detach emotionally and handle our portfolios like seasoned veterans.
Okay, let's just dive right into this. Plus 476%. That is the staggering year-to-date return for AEM Holdings as of mid-May 2026. Just look at that number for a second. When you see triple-digit gains like that sitting right there in your brokerage account, it naturally triggers this wildly confusing mix of intense greed and, let's be honest, deep anxiety. You're thrilled about the win, but absolutely terrified of watching those gains just evaporate.
And that brings us to the core of what we're looking at today. Managing this incredible, happy problem. We are seeing an exploding portfolio of local Singaporean semiconductor heroes. Beyond AEM, we've got Micromechanics up 138% and UMS Integration soaring 160%. These smaller, local players are having an absolute blast, while the giant global names usually get all the media hype. Because of these massive performances, these stocks are suddenly completely dominating top 10 holdings lists. Which leads every investor to the exact same burning question. Is it actually time to take profits and sell your local semiconductor heroes?
So, let's get into the first major hurdle here. The happy investing problem. Dealing with massive gains.
It is incredibly tough, psychologically speaking, to ignore triple-digit percentage gains. Human nature essentially forces us to anchor to our original low purchase price. We sit there and think, wow, I bought this so cheap, I should really just sell and cover my capital. But anchoring to that past price completely clouds your investment logic right now. Your capital is whatever the position is worth today, period. To get over this emotional bias, we absolutely have to look at our positions mathematically. The Fat Investor lays out this brilliant, highly logical decision-making framework with 3 pillars. Before you even think about hitting that sell button, your decision needs to be based entirely on these 3 steps. 1. Assessing the future business potential. 2. Analyzing the current valuation. And 3. Evaluating your downside risk. By strictly focusing on these 3 pillars, we completely strip the emotion out of the equation.
Moving right along to our second pillar, valuations and operating leverage, making sense of the numbers.
So the biggest fear when stocks surge over 400% is that the prices have run way ahead of the actual fundamentals. It's super easy to just assume these stocks are dangerously expensive right now. But let's look at the actual data behind the price surge in this first quarter 2026 business update. The momentum here is absolutely real. AEM Holdings posted an incredible 329% year-over-year jump in net profit. UMS Integration, up 43% in profit. And Micromechanics is showing very steady double-digit growth. While the easy money from that initial cyclical turnaround has for sure been made, these metrics prove that there is real, tangible demand driving these local heroes. This is not just hype.
But you might be wondering, what about those really steep short-term valuations? Well, to understand why they might actually be perfectly reasonable, we need to demystify a secret weapon called operating leverage. Basically, as these semiconductor firms hit optimal capacity with this huge influx of new orders, their fixed costs are spread much thinner. This allows their profit to significantly outpace their revenue growth. So a 20% increase in sales can actually lead to a massive explosion in bottom-line profits. It's a real game changer.
And we can see that operating leverage in action right here. Take a look at these projections for forward earnings per share and price-to-earnings ratios. Notice how those PE multiples are actively shrinking as we move from FY 2026 into FY 2027. AEM's PE drops from 45.1 down to 34.7. Vector drops from 22.7 down to 18.6. By factoring in this continued sales growth and that operating leverage margin expansion we just talked about, these seemingly high valuations suddenly become so much more palatable. The math actually fully supports holding on, especially if you believe demand will outstrip supply straight into FY 2028.
Now let's look at gadgets versus AI infrastructure. Will 2022's crash repeat?
Look, semiconductors are a notoriously cyclical industry, and we just can't ignore the elephant in the room, the fear of a major downturn. But to figure out if 2022 will repeat itself, we have to contrast the fundamental drivers of the current cycle with the past. The 2022 supply glut was driven by a temporary, pandemic-fueled surge in consumer electronics. You know, everybody buying PCs and tablets for their home offices.
Once everyone had a laptop, the demand simply vanished, leaving massive excess inventory. Today's AI supercycle is fundamentally different. This demand is structural. AI chips and packaging are vastly more complex, and they require significantly longer test times. We are building massive structural infrastructure today, folks. We are not just overstocking temporary consumer gadgets like we were a few years ago.
I mean, we all remember the pain of the 2022 cliff drop. It's perfectly captured in these historical charts from Investing Note. When that post-pandemic supply glut hit, the drop in profits across the entire sector was absolutely devastating. And it's vital to remember that eventually supply will catch up with demand again, and a down cycle is always inevitable. However, because we are dealing with structural AI infrastructure this time around, rather than just consumer gadgets, we can reasonably expect the dynamics of the next downturn to be distinctly different.
Furthermore, these specific companies have really evolved since then. They've matured their business models to actively mute the impact of the next down cycle. They aren't just relying on a single customer or product line anymore. AM, for example, now has 5 distinct growth pillars, including high-performance computing and memory. UMS has built a whole new growth path through a major new customer in the foundry space. And Micromechanics is gaining some serious traction in their wafer fabrication equipment segment. This kind of diversification at the company level provides a really powerful buffer.
That brings us to position sizing and risk, passing the sleep at night test.
So we've looked at business potential, and we've covered valuation. Now we pivot to arguably the most important part of our framework. Any experienced investor will tell you that trying to predict exactly when a market cycle turns is completely futile. You just can't time the market. What you can do, though, is mathematically cap your downside. Let's walk through this actual portfolio pie chart from the blog. Notice how incredibly prominent these local semiconductor heroes are. Venture, UMS, AEM, and Micromechanics are all sitting right there in the top 10 holdings. But look really closely at the slices. Despite these being massive triple-digit gainers, careful diversification keeps the total portfolio risk firmly in check.
The absolute crucial point here is this number, 8%. Despite phenomenal explosive growth, strict portfolio management ensures that no single stock breaches an 8% total allocation. Just think about the peace of mind that brings you. It means that even if the cycle turns tomorrow or some sudden black swan event causes a terrifying 40% crash in semiconductor stocks, it'll be a painful loss, sure, but mathematically it will not be fatal to your overall portfolio. You'll still be able to sleep at night.
Preparing for market volatility, actionable guideposts.
Now that we've got our risk mathematically capped, how exactly do we handle the inevitable roller coaster ahead? Well, with current prices already baking in so much of the future growth, we must be mentally prepared for increased volatility in the months to come. So here are your concrete strategic guideposts. First off, it is okay to let your winners run. Allow individual stocks to reach 12 to 15% of your total portfolio if the momentum is really strong. Second, cap your overall sector exposure at 30%. If the semiconductor slice of your pie gets any bigger than that, you must stay disciplined and trim those positions. Finally, be prepared to sit through healthy breathers. Share prices will consolidate, they're going to dip. Do not let normal, everyday volatility shake you out of a fundamentally strong position, but do use these clear percentages as strict triggers to take action when needed.
We've covered some incredibly powerful concepts in this explainer today, from operating leverage all the way to the psychology of holding massive winners. But there is even more detail, including the deeper financial math and some really fantastic original insights waiting for you at the source. I highly recommend heading over to the fatinvestor.blog to read the full article and see these strategies in their original context.
I want to leave you with this final provocative thought as we wrap things up today. It is fantastic to enjoy the party when your portfolio is surging, but discipline is what truly separates the veterans from the gamblers. Have you actually defined your own risk limits? Or are you just riding the wave blindly? Ask yourself right now, while you celebrate your massive gains, are you keeping one eye on the exit door? Thanks so much for joining me for this explainer, and happy investing.